Do you own a rental property? If so, then you'll be happy to know that short-term rentals can save you on all types of taxes. That's right, guys. Having a short-term rental is a great way to access some key tax savings. So what I'm going to do in this video is I'm going to break down everything that you need to know about short-term rentals, how they can save you on all different forms of income taxes. I'm going to break down the history of the Tax Reform Act of 1986. I'm also going to discuss the rental property loopholes that I would love for you to know. And most importantly, I'm going to teach you the rules in the tax code to leverage this strategy to avoid W-2 and 1099 income taxes every single year. Here's what I want you to do. Make sure you stay all the way to the end of this video because knowing this information correctly can help you cut your tax bill to nearly 0%. Without further ado, let's dive in. All right, guys, like I said before, I'm going to teach you the history of this entire strategy so you understand how to leverage it correctly. And I have to take it back for you. It starts off with the Tax Reform Act of 1986. To understand how short-term rentals can save you money on taxes, we need to go over the history first. You see, prior to 1986, individuals who rented out property were able to deduct rental income losses from income that they earned actively, such as income from their careers. Now, what this meant is that people such as doctors, attorneys, or anyone who really had a high salary could easily just buy a rental property or two rental properties and use the losses from their assets, such as depreciation, to offset the income that they are earning from their normal careers. This is because before 1986, the IRS did not distinguish between active business activity and passive business activity. There was just business activity. Although these laws applied to everyone, many people consider them to be unfair because it was significantly easier for people with high incomes to buy rental properties. Many high earners were using rental properties to offset their taxable income, such as W-2 income, 1099 income, and a lot of them ended up paying significantly lower tax rates than lower income earners as a result. So eventually, as many things come to be, after a lot of lobbying and political pressure, the rules were changed during President Ronald Reagan's second term. A bill called the Tax Reform Act was passed in 1986, and it changed the tax rules for rental properties forever. It introduced the tax code known as Section 469. Section 469 introduced passive activity rules. And under this new set of rules, business activities was divided into two categories: active business activity and passive business activity. Now, active business activity is generally considered something that you're actively materially participating in to earn money, such as a day job. Active business activity involves your labor. But on the other hand, passive business activity does not involve your labor, at least we assume. And passive business activity means that you're not truly materially participating, which means that you can deploy your capital and earn benefits from not having to participate in something. Under Code Section 469, all rental income was put into this passive business activity category, which meant that losses from rental activities could not be used to offset income that was actively earned, such as an income from your career as a doctor or a lawyer or an engineer. Now, this new rule dramatically changed the real estate game by making it harder for rental property owners to deduct large amounts of their actively earned income due to depreciation and other types of losses from their rental properties. This isn't where the story ends, so I really want to make sure that you lock in with me right now. Here is where the rental property loopholes start to unfold. Despite the fact that rental properties are considered a passive business activity under the Tax Reform Act of 1986, there are a number of loopholes that still exist that rental property owners can use to make their rental losses qualify as active and thus use them to offset active forms of income, your earned income from your day job. Here are 6 ways that your rental property activity can be excluded from being considered passive business activity by the IRS's definition under Code Section 469 TA. Rule number 1, the average rental periods are 7 days or less. Guys, I cannot stress this enough. If the rental period for your rental property are 7 days or less, then the IRS does not consider it to be a traditional passive rental, and therefore it can be put into the active business activity category. I cannot stress this enough, guys. This is so absolutely crucial and part of the reason why I've helped hundreds of individuals save money by investing in short-term rentals. The reason is because this means that you can use sites like Airbnb, vrbo.com, booking.com, or others to rent your rental property out for 7 days or fewer at a time and get significantly increased tax savings based on the strategies I'm going to teach you inside of this video. So, if you use this short-term rental property strategy, you will be able to offset your rental income losses from all of your other income, including W-2, self-employment income, 1099 income, retirement income, and crypto income. This could result in hundreds, if not hundreds of thousands of tax savings for you every single year because this strategy is one that you can just rinse and repeat. Now, the second rule around getting around the test that prevents us from being able to use our rental losses is step number 2. The average rental period is 30 days or less, plus you provide significant personal services. If you want to make your bookings longer than 7 days, but still be able to access the tax benefits of short-term rentals, the IRS allows you to do bookings of 30 days or less and categorize your rental activity as an active business activity. However, if you go this route, you will have to provide significant personal services as a part of your rental operation. This means that you are providing things such as daily cleaning, you're providing maybe meals, or other things that a hotel might provide, such as concierge service. So essentially, by providing significant personal services, it prevents your rental business from being categorized as a passive business because you're doing more than just providing capital. Now, when you provide significant personal services, the IRS considers you to be materially participating. Want to make sure you write that down. Materially participating in the management and operation of the business and not just providing capital to earn a return. So this is another way that you can use short-term rentals to save on all forms of income taxes. Let's jump to step number 3. You provide extraordinary services. For this option, you do not have to limit the number of days in the booking to 7 or 30. However, you have to provide extraordinary services. What's extraordinary services, Karlton? Extraordinary services can include the things that I mentioned before for option number 2, such as providing daily meals, cleaning, or other concierge services. But according to the IRS, services are extraordinary personal services if they're performed by individuals and if the customer's use of the property is incidental to their receipt of the services. Now, the number 4 way in which we can tap into some of these rental losses and make them active is if the rental is incidental to non-rental activity. The IRS explains this option with this statement. The rental of property is incidental to an activity of holding property for investments if the main purpose of holding the property is to realize a gain from its appreciation and the gross rental income from the property is less than 2% of the smaller of the property's unadjusted basis or fair market value. Now, many people do not go down option number 4, and I would encourage you to probably stick to option number 1 or number 2, but I want to provide you with all of the details. Let's jump to option number 5. Option number 5 is there is non-exclusive use by various customers. Now, for this option, you would have to make the rental property available during defined business hours for non-exclusive use by various customers. That's as simple as it gets. And option number 6, and last but not least, you provide the property for use in a non-rental activity in your capacity as an owner of an interest in the partnership or in an interest in an s-corp or a joint venture conducting that activity. Now, let's break all this down. Basically, as a rental property owner, if you can use your rental property in one of the 6 methods that I just talked to you about, then you will be able to increase your tax savings. And the reason why is because your rental property will be considered an active business activity instead of a passive business activity, which means you will be able to use depreciation to deduct losses against your normal active business income or your active day job 9-to-5 income. Many people who rent real estate are not aware of this loophole and thus they miss out on a large amount of potential tax savings. Do not let this happen to you. You can make some simple changes and save a ton of money in taxes just by adopting a new strategy. Just imagine how much better it would be to be able to adjust your withholdings every single year with your employer so you can take home more of your W-2 paycheck, knowing that you have rental losses happening on your tax return because you're investing in Airbnbs. Guys, I'm not kidding. You can save an extra 5, 10, or even 50, sometimes hundreds of thousands of dollars every single year on your taxes just by adopting this strategy. Instead of giving this hard-earned money to Uncle Sam, you could just spend it on investing in rental properties and grow your business portfolio. I mean, when people ask me, Karlton, how would I rather build wealth? Do I want to build wealth through a business or do I want to build wealth through investments? I can tell them now, hey, starting a real estate business is a business and an investment. You're getting paid cash flow, the property appreciates, and you get depreciation at the exact same time. I get asked this question all the time. Karlton, which option is best? Should I go with long-term rentals? Should I go with short-term rentals? For many people, the short-term rental real estate options are the easiest and best options to use the active business activity loophole for rental properties. This is because the time requirements that are involved with unlocking the losses to offset your W-2 and 1099 income. So if you would like to use the short-term rental loophole strategy to minimize your taxes, then all you have to do is limit your bookings to 7 days or less and make sure that you are materially participating in this business. Considering that the average Airbnb booking length is only 3 to 4 nights, it'd be pretty easy for many people to do if they knew about this information. If you live in an area where you know that there is high demand for Airbnb rentals, such as like a major city, it will be even better for you to do this. Maybe you're living in a tourist location, right? Then it's even easier for you to use this option. But even if you don't, it can still work just as effective as long as there is relatively consistent demand for your listing. Most Airbnb listings experience good booking rates. In fact, the average Airbnb listing is booked for 21 out of the 30 days in a month. If you would like your bookings to be a little bit longer, you can extend them up to 30 days as long as you add significant personal services into your strategy. If you are unsure what services to add, just ask yourself, what services do a hotel typically add that I can add into my business? As I mentioned before, this can include laundry services, it can include cleaning services, cooking services, concierge services. But the important thing is to make it clear that you are not simply just deploying capital and that you are actually putting in labor to add to the overall experience that your guests have when they book your short-term rental. Now, here's the thing I want to make sure that you do. Make sure that you keep track of all of your expenses and other documents related to the significant personal services that you provide if you go this route. That way you'll be able to provide it to the IRS if they're ever questioning you in an audit. As a matter of fact, this is what I train all of my students on inside of Tax Alchemy. I do not let them take this strategy without downloading our real estate professional log booklet and filling out our log booklet as they go about performing personal service hours. Here's the next thing we should talk about is what kinds of properties qualify for short-term rentals. This exact rule for what I'm talking about might be different depending on what state you're in. However, all of the following properties that I'm about to name out to you technically qualify to leverage the short-term rental strategy. You can leverage the short-term rental strategy with apartments, houses, condos, cottages, but even though these options are common for short-term rentals, they're not the only types of properties that can be used for short-term rentals. For example, on the popular short-term rental site Airbnb, you can find a number of unique short-term rental properties, such as tree houses. You can find passenger planes. You can even find properties that have been converted to look like little hobbit houses from Lord of the Rings and spaceships. I mean, there's literally everything on Airbnb. People definitely get creative when it comes to creating short-term rentals, that is for sure. Now, some people rent out their short-term rentals themselves. However, nowadays it is more common for people to rent out their properties through intermediaries or operator agents such as Airbnb, HomeAway, VRBO, Booking.com, or any of these other similar hosting platforms. But is there any other way to make your rental properties count as active business activity without having to go down the short-term rental route? Well, yes. In addition to the 6 methods that I mentioned above, and by the way, you let me know if your tax strategists have shared those 6 methods before, because I want to make sure you guys are getting all the game on this channel. There's actually one additional way that you can get your rental properties to count as active business activity. And this is through something called the real estate professional status, or REPS for short. Real estate professional status is a special status that is given to people who work in the real estate industry. Now, if you put in enough time during the year working as like a real estate professional, a real estate broker, doing real estate leasing management, there's 11 different real property trader businesses, then you might be able to qualify for real estate professional status. Not everyone who works in the real estate industry is able to qualify for real estate professional status. In order to qualify for real estate professional status, you would have to meet all of the following criteria, which includes over half of the personal services that you perform during the year are in your real estate business. That means you're spending half of your time in real estate than any other thing. And then number two, you work at least 750 hours per year during the tax year in your real estate business, and you materially participate in these activities, meaning you are actively involved in the management of your real estate business. So as you guys can see, obtaining real estate professional status is not easy. Matter of fact, majority of the taxpayers who I work with will have a designated spouse on the tax return, such as a wife who stays home and takes care of the kids, or maybe a husband who stays home and takes care of the kid that is not earning a salary, will qualify as the real estate professional on the tax return and manage the portfolio so we can tap into the real estate losses. Many people who just want to have a rental property or two will not qualify for real estate professional status and thus will not be able to avoid the normal passive activity loss rules that were implemented in 1986. However, if you are someone who does work mainly in real estate and meets the criteria to obtain rep status, then it could be worth your while to get it. And maybe if you succeed, then you can use your rental losses every single year like a majority of my clients and be able to tap into tax-free wealth. The most important thing about understanding rental losses is how you use them. Most people who come to me are trying to use them to avoid W-2, 1099, self-employed income. And that is part of the reason why I will strategize with them on buying properties strategically that can help them offset their W-2 and 1099 income. But if you want to keep your rental property income as passive as possible while being able to deduct their losses from your active business, then you should consider going with one of the two short-term rental options that I've already mentioned. This is part of the reason why majority of taxpayers who are W-2 will stumble across to my YouTube channel. It's because I teach them how to invest in short-term rentals to avoid W-2 income taxes. Because I know they can't spend 750 hours. I know they can't show the IRS that they're spending more time in real estate than their W-2 jobs, nor do they even want to, right? So let's talk about this. How hard is it to set up an Airbnb, or how hard is it to set up your property on VRBO? You know, although many people who own rental properties would like to take advantage of this tax benefit I'm talking to you about of short-term rentals, they may not know exactly how to run an Airbnb or VRBO business or any other short-term rental business. Many of these people have been renting their properties with long-term leases maybe for years, or maybe they haven't even been renting a property for all. And this will be the first time going into renting out a property. The process of creating an Airbnb is actually very simple. In fact, in some cases, it can be done as quickly as like 24 hours. It mostly just involves uploading photos of your property and entering information about the property online and getting a property furnished. Usually after you create your Airbnb listing, it is live and appears in search results within about 72 hours. So that part right there isn't the hard part. It's really getting yourself to understand that you're going to be a real estate investor and a landlord. So even if you have never used Airbnb or have never done short-term rentals, the process is very straightforward and easy. If you try it, you might be surprised at how easy it actually is. The hard part is making sure you understand and align yourself with the tax strategist that's teaching you the tax savings before you put an offer on a property. Ding, 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 ding. So question is how do you deduct losses from your rental property? Now that you know that you can get this additional tax deduction, you're probably wondering like, dude, how do I actually get the losses to show up on my tax return? That's the most important part. When it comes to rental properties, one of the most significant losses that most owners experience is through depreciation, Karlton's favorite word in the tax code. Depreciation is the loss of the value of a property over the time due to the wear and tear. There's two different ways to calculate depreciation. The first is to use like the standard straight line method of calculation set forth by the IRS, which is divide the valuation of the property by its useful life over the course of 27 and a half years, equal in amount over 27 years. Oh my goodness, Karlton, 27 years is too long. Yes, I understand. I'm not going to have you wait 27 and a half years to get all of your depreciation. So what we can choose to do is use a modified adjusted cost recovery system. And this allows for us to accelerate depreciation, giving us an added benefit. But let's just talk about straight line, for example. I want you to understand the differences. For example, If your property was worth $1 million, and if you use this equation, then your property would depreciate by $36,364 every single year, okay? The second method that I want to talk to you about that we use in my office is called the cost segregation study. Now, a cost segregation study has been probably told to you before that it's expensive and you shouldn't do it. And what about depreciation recapture? I'm going to talk to you guys about all of that. And these are things you should definitely not fear. First off, cost segregation studies are not that expensive. Your CPA or whoever you're getting that information from is telling you a lie. They're not that expensive. And secondly, we do not worry about depreciation recapture in my office because we have strategies for it. Why am I going to ever pay taxes later if I'm front loading depreciation? That's not my strategy. Let me explain the second method to you. A cost segregation study is a tool that allows real estate investors like myself, like you, and many others the ability to separate certain elements of their property, such as the wiring, such as the light fixtures, such as the appliances, such as the flooring, such as the drywall, such as the pool. And we can accelerate depreciation, all of these items. You see, a cost segregation study is an alternative way to calculate depreciation losses for rental properties. And many rental property owners prefer this method as opposed to using straight line depreciation over the course of 27.5 years. See what I'm saying? Because time value of money would tell you, why not save more money right now, knowing that inflation is literally at 8.5%, and I don't know when inflation is going to go back down. Do you? So this is part of the reason why many entrepreneurs and many taxpayers and many W-2 taxpayers mainly will use the cost segregation strategy to accelerate depreciation. Not just anyone, guys, can perform a cost seg. So I don't want to get you all riled up. And this is because not everyone is an expert in construction. You see, according to the IRS rules, cost segregation studies have to be performed by firms that demonstrate construction engineering and accounting expertise. And that took me and my firm a lot of time to make sure that we had the right engineers, the right accounting, and the right expertise to be able to offer cost segregation studies. And we've been doing it for the last 10 years. So make sure you hire such a firm to perform your cost segregation study if you decide to go this route, regardless of whether you use the traditional method of calculating depreciation or the cost segregation study method. If you make the right moves, you will be able to deduct your rental losses from all of your income, including your active earned income, as opposed to just your passive income. Here's the ending and what I really want to make sure that you walk away with, because we've reached the end of this video, guys. So congratulations on making it this far. Here is what I want you to know. Here is what I want you to walk away from with this video. Number one, there are still some loopholes for rental real estate that allows you to get better deductions for rental property losses, including depreciation. This is part of the reason why I align with real estate over stocks. Number two, the easiest way to do this is to use the short-term rental rule that I have expressed to you. The length of days is 7 days or less, or have bookings of 30 days or less and do significant personal services. Number three, there are several other ways to do this, including obtaining a real estate professional status, but this is not widely done. This is for specific households, specific families that are able to qualify for the real estate professional status. Guys, listen, if you guys have any questions about using short-term rentals to help you save money on taxes, or if you have any other tax questions, you're more than welcome to get in touch with my firm. We have links below. Feel free to click on them. You can also click on the link to Tax Alchemy. I've dedicated over 1.5 years creating this online program that teaches you how to use short-term rentals to avoid W-2 and 1099 taxes. This video was honestly just the icing of the cake. You need to dive into the entire cake. There's so many different components of leveraging real estate to avoid taxes. And once you understand it, you will be able to develop your strategy to continue to repeat this over and over again. Guys, listen, my name is Karlton Dennis. You know what to do. Like, comment, subscribe. I'll see you on the next video. Hope you'll be investing in real estate. Talk with you soon.